Welcome to the What to Watch video update. This is the last video that I do each weekend where I look over the past week, take a bunch of charts. I have a positive side, a negative side, and then a side that I'm just kind of keeping an eye on. Now, we were looking pretty good. We were actually turning more positive up until Friday. Then we had a pretty significant down day. Given that, we have to ask the question, has the S&P 500 made a short-term top? This is being prepared for Monday, February 24th. The first thing we look at are those charts that are still positive. Now, with most of these charts, there's a positive side, there's a negative side. You can interpret it depending on how you look at it, either on the good side or on the bad side, that things are getting better or worse. So just be open to that as I go through these different charts, and I'll try to point that out along the way. The first thing is we look at an intraday chart going back to Tuesday. We were closed on Monday, and things were fairly sleepy. We were just continuing along. In Tuesday's session, we saw a nice little pop going into the close, and we saw some late day buying. Okay, that's usually when the smart money comes in and does something. And then the strength that we saw came in Wednesday's session where we had a lower open, but then we're able to claw our way back and close just a little bit off the high. So things were looking pretty good. Then on Thursday, okay, we had a lower open here, but then we were able to establish a base and then see some more late day buying coming in. That was still positive, even though that was a down day. Then everything seemed to switch on Friday. Now, one thing about Friday is it was options expiration. That's kind of its own day. It can have its own characteristics, but it did a lot of technical damage. And we didn't have much of a gap. We saw most of the weakness coming in as we fell below S1, S2. We went all the way down to S3, which is right at about the 50-day moving average for the S&P. We were not able to bounce up off of that. There were a few attempts, but they really didn't go anywhere. And we ended up closing pretty much at the low on Friday. So it has a lot of people concerned right now, and maybe that's what the market wants. We haven't been trending when we look at the short-term chart, the intermediate-term chart, and even the weekly chart, but we've been hanging in there. And you have a lot of folks that say, okay, the market's going to go up. We just need to wait a little while, or maybe I'll do some buying, this buy in the dip type of idea, which I personally don't implement. I wait to do what the charts are telling me. I don't just come up with well, it looks like we're coming down here to S3. Maybe I'll do some buying. Well, it wouldn't have worked in Friday's session. So I take a bit of a different approach with that, but you may differ in that. Now on the negative side, though, even though the market has been holding up, we're coming into a weak seasonal time historically. The second half of February is not particularly a strong time of the year. And then February in and of itself is a weak time after we've had an election. So you take that together, and a lot of folks are more pessimistic on the market right now. I will say that a week ago, I was reading through some perma bears because I'm not a perma bull, I'm not a perma bear, I'm a perma realist. And one of the perma bears that I just kind of loosely follow was actually kind of positive on the market. And I went, oh, great. Here we go. Because I use a lot of these perma bears as contrarian indicators. If they say we're going up, I'm afraid we're going down. They're pretty much always saying, though, that we're going to go down. And that's why we go up about 70% of the time. But it just depends on your own perspective on things. Now, we're holding at some critical levels right now. Some damage has been done in the short term, but we're going to be watching in the upcoming week, and I'll point it out throughout the rest of this video, those levels that we're going to be watching. Okay, first on the positive side. Now, you could easily put this on the negative side. It's positive when the blue line's above the red line, and that's why this is on the positive side here, even though it really took a hit, and growth did not have a good week. But the blue line, which is large cap growth, is still outperforming large cap value, which is the red line. When the market is more positive and going up, growth stocks are favored. Buy low, sell high. When the market's getting more defensive, especially money managers that have to stay invested all the time, they'll get into stocks that may not go up, but they may go down less than other stocks. And that's when you see the red line outperforming. So far, with the blue line above the red line, we're still positive that with this chart anyway, if we do cross below, even though they're on different scales, that would mean that value is starting to outperform growth, and that would turn things more negative. Also, going back to the end of January, we were looking at growth versus value just for the S&P itself. This was looking pretty solid, even though we were going sideways and not really falling all that much. And days when we did fall, we still saw this ratio going up. Well, long about the 10th of February or so, we started to level off, and now we're seeing some weakness. Now, I'm keeping this positive because I'm going all the way back to the end of January. If this continues to fall, yeah, that would be more negative, but maybe we'll be able to bounce up off of this and regain this upward trend. Also, the growth to value ratio for the S&P, we're still in a longer term uptrend, even though we fell down with this ratio, and this is an end of day chart. We came below the 50-day moving average. So yeah, we're taking a bit of a hit here. You can't deny that, but longer term, we're still positive. And then we look at a growth versus value ETF. Also, it never really broke out of the rainbow recently, and that was part of the concern that we were seeing, but we haven't really fallen down too far deep into the rainbow yet either. So the lines are still going up, and this ratio still is above most of the lines. So I'm still treating that as positive until proven otherwise. Discretionary to staples, it took a hit too, falling down when we look at this ratio below its 50-day moving average. And it wasn't so much that discretionary fell apart on Friday, even though it had a down day. It's that staples had a really strong day. And that's what we're watching now. Staples, that's a defensive area. Toilet paper, toothpaste, things that you have to have no matter what's going on in the stock market or the economy. And so those stocks tend to hold up better and sometimes even advance when we're in a downward market environment. But going back to last summer, discretionary has really been outperforming staples. Now, a lot of this has to do with Tesla, and it's been under a lot of weakness lately. And that's why we're seeing this ratio really coming down. But in spite of that, it really just started to top out about the time that Tesla was having problems. Well, I also keep an eye on Tesla stock. I don't trade it or do anything like that, but I do have charts in the daily video that I go through, and we'll be seeing if there's any improvement there. Amazon is also included in the discretionary sector, and it's been doing pretty well, even though it got hit this past week, as in addition to pretty much everything else. Now, we're seeing some positive things and some potentially negative things here when we look at some growth to value ratios. The Qs to S&P, it's declining, but still above an advancing moving average. That's positive. That's the NASDAQ 100. This is where we're seeing some weakness. Discretionary to the S&P had been doing really well. Then we leveled off. Now we're seeing this ratio going down. And we were kind of going sideways here when we compare large cap growth to value, but now it's starting to decline a little bit. The reason why this is still positive is mainly because of the Qs to S&P, because those are the big Magnificent Seven stocks, which have been lagging over the last, well, pretty much for all of 2025. They really haven't done all that well. NVIDIA's earnings are going to be coming out pretty soon. We'll see if that has a catalyst either on the positive side or negative side. But we would like to see this chart doing better than it is, but it's positive because of the top ratio. You could actually call this more negative because of the bottom two. And we're still below a declining moving average at the large caps. The mid caps are just getting hit, and the small caps are getting hit even harder. So, yeah, you could have justified putting this on the negative side. And when we look at the end of day chart for small cap growth to value, we're still in an uptrend. The blue line's above the red line, but we're coming right down to the 200-day moving average with this ratio. We haven't fallen below that. If we do, this would definitely be more negative. But because we're still in an uptrend and we just came right down to this red line, can we bounce up off of that? That might be more positive. And you can see here, going back into December, I mean, the small caps have done nothing. They were supposed to take off and go to the moon. Well, they break to the downside. Then we have a couple of good up days. They go sideways, and now they're giving back pretty much all those gains, and they're actually negative on the year now. So this area just hasn't cooperated all that much, and some of that can be attributed to higher interest rates. These are smaller companies. They have to borrow a lot of money. What they're paying in interest, that takes away from their bottom line, and that can often hurt stock price and the profits of a company. Seeing a similar thing here with mid-cap growth to value, it fell below its 50-day moving average. It's not all the way down to the red line, but it's still in an overall uptrend. And this is another index that looked like it was doing a lot better. And now we see a series of lower highs and lower lows. And that's not necessarily positive there, but we'll see if this ratio can show some improvement. Large caps to small caps and taking a ratio, this actually went up in Friday's session. And it's not because the large caps did well, they got hammered. It's because the small caps did worse. And so that's why we're seeing this ratio going up. But typically, when this ratio does go up, that's more positive for the market. And then looking at the long-term trend, which is still positive, this is the ADX. And this is what I use in a number of different time frames to evaluate the current condition of the trend. Are we trending? Are we not trending? Right now, we're not trending because the black line here, which is the ADX, is below 20. That's a static number that I use to determine whether we're trending or not trending. Then, are we getting stronger or weaker? Well, I also put a moving average on here. And when we're going down and below the moving average, that means that we're not trending. And what trend we may have is getting weaker and weaker and weaker. So that's the condition of the trend on a weekly chart. But you see that where the green line, even though it's coming down, is above the red line. That's why this chart is still positive. Later on the negative side, I'll show you a short and intermediate term chart of the daily ADX, and those have now turned negative after Friday's session. And the VIX, why is this positive? It went up in Friday's session. Okay, it did, and you can't take that away, but we're still below 20. When we really get negative with the VIX is when it goes up above 20, and it hasn't done that at least yet. The advanced decline line took a hit in Friday's session, rolled over a bit here. We haven't been able to surpass this previous high. That's kind of on the negative side, where this past week on 2 days, Tuesday and Wednesday, the S&P did set a new all-time high. So that's a bit of a negative that we're seeing here, but we're still above an advancing moving average, both based on price and volume. Now, one thing on the positive side that I had been picking out is that volume was showing more intensity than price. You can see volume was going up where price was going sideways, and sometimes that can lead. Well, in Friday's session, we saw volume going down with more intensity than what we saw with price. And so maybe that's not a good interpretation to use right now. Then also on the positive side is we look at the 5-day average of the highs minus the lows for the S&P. We're still going up even though we're rolling over. On the negative side, the 10-day moving average is now going back down. But when you look at this chart and take the red and the green together, you can see that there's a lot more green than red. So that's why I decided to keep it positive for the time being. But we are seeing a contraction of the new highs, but we're at the same time seeing a contraction of the new lows. And this is what typically will happen when we are in more and more of a sideways type of a market or a non-trending environment. Now, this is also positive, but you could put something negative into this. Disregard what you see here at the bottom. Just look at the indicator itself and then the red line. This is accumulation distribution, and this is smart money indicator number 1. We were a little bit concerned that we were getting kind of far away from the moving average, and that's what this lower indicator is supposed to measure, but it's just not doing a good job of that, so we have to eyeball it. Now, could it be that we're just coming back down because we were getting far away from the moving average? It could be that. If this continues to fall and get to the point where it drops below the moving average, that would be negative. But for right now, we just see this as positive, but pulling back. And it's our only smart money indicator right now that's actually positive. I have 3 of them, and the other 2 have actually already turned negative. Now, the advanced decline ratio, both in the short and intermediate term, the short term is the blue line. It's declining, but still above 0. The red line is intermediate term. It's declining. It's hard to see there, but it's also still above 0. Parabolic SAR on the daily chart. Even after the decline that we saw, we still have the dots underneath, which is positive. And the weekly chart, even though we've been chopping around and not really going much of anywhere, we're still positive on the weekly chart as well. Now, the condition of the short-term trend. Now, we've turned negative in the short term. That's because I use a simple and exponential moving average to measure that. This is a double and triple exponential moving average, which moves a lot faster. Even though we've dropped below these lines, the lines have not really rolled over and started to go down with any conviction yet. That's why I decided to keep this on the positive side. But because we're below both lines, you could also treat this as negative. And the same thing with the intermediate term trend. We're below the blue line and the red line, but the red line and the blue line are still continuing to go up a little bit to sideways. And right now, the 50 period moving average is still holding, which is the next chart. See how we came right down to this level? Now, the simple moving average, that's what most folks use, and that's the red one. The blue one is an exponential moving average, and it moves faster. They're right about equal with each other right now. Typically, when the blue line's above the red line, that means the trend is stronger. And it was trying to get a little bit stronger there, but they pretty much met up with each other, and then that served as support in Friday's session. That was also the close in Friday's session. We look at all the moving averages. So we're below the 20 period simple and exponential moving average. We're right at the 50 period moving averages. Now, if we see more weakness, then we'll be watching the 100 period moving average, which is still going up for right now. And if we fall below that, we'll be watching the 200 period moving average, which is also still going up for the time being. We keep an eye on the advanced decline line. I mainly focus on the S&P 500. That's why this is still positive. Even though it's declining, it's above its moving average. But if you look at the NYSE common stock, we're coming down a little bit below the moving average now. We're dropping below the moving average at the mid caps, and we're falling further below the moving average with the small caps. So yeah, there's some weakness in this chart, but since I focus on the S&P and it's above its moving average, I decided to keep it positive. Long term, this is a weekly chart going back to the 1987 crash, still far away from that trend line. So we're positive in that aspect. Now we look at some other markets. The NASDAQ 100, yeah, it got hit in Friday's session, but it's still above its 50 period moving average. The momentum for the NASDAQ 100 took a hit on Friday, starting to roll over, but it's still hanging on to being positive. If this drops below and the PPO keeps going down, that's going to switch it over to negative. And then we look at a ratio between the Qs, which is the NASDAQ 100, and the IWM, which are small caps. This ratio keeps going up. And it's really because of small cap weakness. And that the Qs are holding up a little bit better right now. Total US stock ETF did come all the way down to its 50-day moving average, but it's holding at that level for right now. Financial sector also got hit on Friday, but still hasn't even come down to its 50-day moving average. And then we look at some ratios. Now, what this tries to measure is stocks versus bonds. And when we're going up like this, that means the market thinks there will be a soft landing. That means no recession. If we were to come down into this area, that means that they're expecting a recession to happen. Even though we're coming down into the rainbow here, this ratio has still been holding up fairly well. See that same basic thing when we look at the S&P 1500, which is another broad market measure, and compare it with short-term bonds, 1 to 3 years, based on price. Yeah, it's coming down into the rainbow, but not falling apart, at least yet. Another broad market measure, looking at 3 to 7 year bonds, taking a hit, but still holding up. And we look at the tech sector to 3 to 7 year bonds, taking a hit, but still at the top end of the rainbow. The QQQs to 3 to 7 year bonds, coming back into the rainbow, but still holding up for the time being. And then a weekly chart of the NASDAQ 100, we're still above this long-term trend line going back to 2009. We look at a ratio between the NASDAQ 100 growth and the Dow, which is perceived to be value. This is still above this red line. We were supposed to go up to this, according to the perma bears, hit this and turn and then just go in the toilet after that. Well, we went down a little bit here. This is 2021 going into 2022, but for the time being, this ratio is still going up, and that would be taken as positive. And at least we're getting down below the 4.5% level with the 10-year yield, and that's why this is on the positive side. If this is going up, that means interest rates are going up. Well, lately we've been coming down for the most part. It's been really choppy. But if this can continue to fall, that may give support to stocks, which in this case could end up being positive. because it was right around the 4.5% level when the stock market started to freak out about interest rates. And there's nothing magical about 4.5. It's all relative. It could be a higher level, a lower level. But that's about the point when the stock market started to notice that interest rates were going up, and we saw some problems there. If interest rates can stay under this 4.5% level and keep falling, that may help things. And this is an intraday chart that I've been following, and I have a red, it's not red, it's blue. I have a solid line here at 45, which equates to 4.5%. And we did come down. You can see, do you think this is important right here? Yeah, it really acted as support on Thursday. Then we broke below it, but that didn't really help stocks in Friday's session all that much. This was coming down in the fear that there may be some economic weakness and sentiment is turning more negative. And this is a daily chart of all the different maturity rates here. And for the most part, we have been coming down. But if we start to go back up, that would be more negative. Now we look at the negative side of things. You look at sentiment here, called the Fear and Greed Index. I get this at cnnmoney.com. And we have not been able to get back above 50 so far in 2025. It was back into, well, late in December when we set the all-time high, when we were looking somewhat positive there. But since we're going down and we're below 50, I'm treating this as negative. Now, if we come all the way down to 25, that's when we start to say, okay, folks are too pessimistic right now. Let's consider looking at this in a contrarian way. Just like when we're going up and we get above 75, everybody's positive, everybody's happy. That's when we start to get a little skeptical about things and look at maybe getting out of some long positions. Then this is on the negative side because of the red line. This is smart money indicator number 2, the Chaikin money flow. This had been really positive, and we were getting a very high reading here after Thursday, higher than what we've seen on this chart, and the red line was going up. Well, in Friday's session, this really dropped off enough to turn the red line down. Now, it's still positive when you look at this. It's green, but we look at the red line. Now, if this continues to fall, that would continue to be negative. Maybe it's working off some of its extreme reading before it's getting set to turn back up and go higher. That would be more positive. But since the red line is going down, and that's all we can really go with is what we see right now, we have to treat this more as negative. Our third smart money indicator, the Chaikin oscillator, a higher reading than what we've seen on this chart over the last year. It's coming down. I also plot a moving average on here, and we're below the moving average, and we're coming right back down to this green line. And the context is that this is declining, so that is negative. The vortex, another primary indicator that I use. Now, these are pretty much on top of each other, but if you look over on the left, the red line is at 0.94, where the green line is 0.93. So that's why we're treating this as negative, because the red line is just a teeny tiny little bit above the green line. And the momentum for the VIX, which when this is going up, fears coming into the market and stocks are going down. Well, it had been that the momentum was flat to actually declining, but with the VIX really going up, even though it's below 20, it's still really shot up in Friday's session. That's turned the MACD up. And when the momentum is going up, that's more negative for stocks. Then here's the short-term ADX, or average directional movement. We're trying to flatten out here. We're getting very low readings, well below 20. We're at 7.55 right now. You might make a case that we're actually trying to climb above the moving average yet, but we're not seeing an awful lot of conviction. Up until Thursday, the green line was above the red line. After Friday, the red line went back above the green line, and that turned this overall negative. Here's the one that I focus on the most, the intermediate term. We're still below the moving average, but we're trying to flatten out here, and the red line is above the green line. So this is negative. But if you remember back to the weekly chart, it's not trending either, but it's still positive. And we dropped below zero with the advanced minus decliners over a 10-day period. We had been showing some improvement. After Friday, we turned more negative here. And this is the 20-period simple and exponential moving averages. We dropped below it and closed below it, so that's turned the short-term trend to negative. We're falling below zero with the S&P McClellan oscillator, where it was trying to show some improvement. Well, not on Friday. And so we're starting to roll over here with the summation index based on price and volume. Not an awful lot of conviction yet. We were getting more encouraged because we were seeing volume going up with more intensity than we were price. And sometimes volume can lead price. Not in Friday's session. So we'll see if this can recover and start to go back up. Now, the reason this is turning down is because of the preceding chart, the S&P McClellan oscillator. When it's above zero, and the further away it's above zero, the more intensity it has. When it drops below zero, that turns it negative. And that's why we're seeing this next chart starting to turn down. And then the NYSE McClellan oscillator also dropping below zero, so that's turning negative, which is very hard to see, but we're starting to roll over here based on price and just barely hard to see, or it's really hard to see here based on volume. But we've been seeing things really chopping around with volume lately on the broader market. So on the trending oscillator, we were positive on this chart. We were going up with more intensity based on volume than we were going up based on price. After Friday, now we're turning down with both. Now, we're still above zero, so they're positive, but we have to look at the context of this chart, and they're declining, so that's negative. And we were just about ready to switch over and look more positive with our momentum indicators. I have two short-term indicators. They were starting to improve a little bit here. We're still pretty much flat with the slope, but we're turning back over and going down with the TSI. We were starting to turn more positive with the three intermediate term oscillators, but now they're dropping below their moving averages. We're still positive with the tricks, but we're coming down to the moving average with the KST. Those are two long-term oscillators. And the copy curve was just about ready to cross over positive. Nope. Friday came along and now we're rolling back over. This is another momentum oscillator. And we're going down below the moving average with the bullish percent index. We're still above 50, so that could be taken as positive. But we look at the direction of this line, and it's clearly going down right now after being quite choppy. And we're below 50 now with those stocks inside the S&P above their 20-period moving averages. That's turning this chart negative. We're declining, but still above 50 with those stocks above their 50-period moving average. So this is holding up a little bit better. But what's kind of interesting is we're already below zero with those stocks above their 100-period moving average, and we're still well above 50 here. We're into the high 59s, which is not a great reading. That means that just under 60% of S&P 500 stocks are above their 200-day moving average, but we're still above 50. But this is also declining now, and I like to keep these charts together when I can. This is an indicator that I created a long time ago. It's very simple. It's just a simple moving average of the open, high, low, close. And what I've found over the years is when we're above this mini rainbow, and then we come down, excuse me, and then we come down, quite often one of these lines will provide support. Even though this is based on 20 periods, which is short term, this kind of acts more intermediate term. Well, in Friday's session, we just sliced on through the rainbow and we're below all these lines right now. If we stay below this, the lines will start to roll over and turn more negative. This is something I've been pointing out since we hit the all-time high back in early December. This is a trend channel going back to 2009 for the S&P. We just cannot seem to get above this, and this could be providing long-term overhead resistance. Now, there's a positive side and a negative side from this chart. We had the S&P itself hitting an all-time high 2 days this past week, but that's a positive side, but it was not confirmed by the NASDAQ. Now, this is kind of a new way of looking at Dow theory, where traditional Dow theory uses the Dow and the transports. Well, a new way to look at it is instead of using the Dow, we use the S&P, and instead of using the transports, we use the NASDAQ. So there's a positive side and a negative side to this chart. And we're seeing kind of the opposite of that with this next chart. This further breaks it down. Instead of using the regular S&P, we use the equal weight version, which has not set another new all-time high. But if we look at excuse me, gotta love it. I do all these videos, take one, and I would rather spend my time doing research and recording than editing. So you have to excuse my clearing of my throat at times. Okay, so we didn't set a new all-time high with the equal weight S&P, but we did with the NASDAQ 100 equal weight. QQQs, that's also a non-confirmation. Now, you could take it as positive because the Q set an all-time high. You could take it as negative because it's not confirmed here. We did drop below the 50-day moving average with the Dow. Okay, so that's why I'm treating this as negative. But longer term, we are still in an uptrend. The Wilshire, this is a broad market measure, holding up quite well. It closed below its 50-day moving average on Friday. And where the NASDAQ 100 is above its 50-day moving average, the NASDAQ itself broke below it, and it's right at this pivot point. Now, that could be positive. We might be able to bounce up off of this. These pivot points are usually pretty important for the NASDAQ and NASDAQ 100. We'll see if it ends up being that way this time, even though the NASDAQ is still in a longer-term uptrend. Small caps just really having trouble right now. They're still in an uptrend, but you can see how the 50-period moving average is just rolling over, and we have not been able to get above the 50-period moving average. And then in Friday's session with the S&P 600, we broke below the 200-day moving average. Now, I look at another small cap index, the Russell 2000, we're right at the 200-period moving average. Could this be positive? We came down to the 200-period moving average before and bounced up off of that. We couldn't get above the 50, but at least we had a few good sessions in here where we were going higher. We're right about at that same point again. Now, if we break below this, yeah, that's going to turn things more negative. And the small caps are continuing to really underperform the S&P. And it's not like the S&P was up on Friday. It's that the small caps got hammered even more. Mid caps also coming down and dealing with their 200-day moving average. And so far, excuse me here, so far, we're still above the 200-day moving average. And we're still in a longer-term uptrend. But this index has pretty much done nothing. All right, then the bank ETF. I was more encouraged when we were back above the 50-day moving average. We came down and closed below it on Friday. We want to keep an eye on the financial sector to see if everything's doing okay there. I went through the whole great financial crisis, and so I want to be watching for these things in case something like this starts to develop again. And yeah, we're seeing some weakness, but nothing catastrophic like what we were seeing in late 2007 into 2008. All right, then the FANG index, these are the really big stocks. Facebook, Apple, Amazon, Netflix, Google, Nvidia came below their 50-day moving average, even though it's still in a longer-term uptrend. And we broke below this longer-term trend line with the FANG index as well. Now, we've dropped below it before, and we've been able to recoup that. Is this going to be the same thing where we go back above this long-term trend line, or are we going to continue to come down? And then home construction to 3 to 7 year bonds. This had been holding up quite well going back to the beginning of 2023, looking pretty good. Came down to the 250-day moving average twice and bounced up off of that. Now we broke below the 250-day moving average, and we're seeing all these lines rolling over, and this is not a very pretty looking chart when you compare home construction to 3 to 7 year bonds. This is potentially a concern when we look at staples, which are defensive to the S&P. For the most part, this has been coming down. Now it really spiked up in Friday's session. Is this just something short term that's going to be dealt with very quickly? Or are we starting to see a real shift in this ratio? And if this starts to go back up, that's going to be negative for the S&P. If this can turn and come back down, that would be more positive. And we did drop below the 20-period moving average with the QQQs, which is the ETF for the NASDAQ 100, but we're still above the 50-period moving average, and all these lines are still going up for the time being, so they're still in uptrends. And then large cap growth, this is another area that had been holding up fairly well. When we drop below the 50-period moving average here, we're still above the 100-period moving average, but we've just been kind of going sideways for all of 2025 so far. If this continues to fall, naturally that would be more negative. So far, these lines are still going up. If we can get back up here above the blue line and keep going up, that would keep these lines going up as well. Semiconductors to Dow, this is one of the tech areas to value. It's actually improved a little bit recently, but it's not outperforming. And we're below this blue line here. So we're just keeping an eye on this. As long as we're kind of looking lower and lower for the most part, that's why this is on the negative side. Then some areas that I'm watching. We want to keep an eye on weekly jobless claims, which did go up in the latest reading, but the moving average, the 4-week moving average is still going down. And continuing claims kind of going sideways right now, but we're actually declining a little bit with the moving average, even though it was up in the past reading. And then just to give it some more context, the red, those are the initial claims, blue, continuing claims, and then the unemployment rate. We'll get that at the first part of March with the next employment situation report. And the skew index still for a couple of months now, it's just been giving us high readings up in this red area, meaning the market is expecting some kind of a move. Well, we had a big move in Friday's session and this barely moved. So we're just keeping an eye on this. And I'm not sure the context of this one. And we're looking at cash to 3 to 7 year bonds. This is actually holding up fairly well. If the market was more concerned on a short-term basis, now this ratio is still going up, but it would keep going up if they were more concerned. And we look at TIPS, which are Treasury inflation protected securities, which do adjust for interest rates based on inflation. This is in a downtrend, but we're just kind of chopping along sideways here. Not a lot of concern. Where we see concern is when we compare TIPS with further out bonds. And this is going up, even though it came down in Friday's session. We want this to come down to be more positive. If this continues to go up, that means there are inflation and interest rate concerns. We want to keep an eye on the 10-year yield in Japan. It's continuing to go up. And when it crossed above 1% last summer, that was what created that crazy day that we had on August 5th. Well, this keeps going up now. And so far, it hasn't led to too many problems. You're not hearing about it in the pop news cycle. But we just want to watch this in case that does end up turning into something. And we're keeping an eye on oil, which is actually going down. We're getting to the low 70s now. And we always want to keep an eye on the dollar. It's still in an uptrend, but it has been pulling back, and it's in a short-term downtrend according to some other measures that we look at. But this is more intermediate to somewhat long-term when the purple line is above the orange line here. So it's still in a longer-term uptrend. Thank you. Sorry about my throat clearing all the time. Now it seems to be working fine. Have a great weekend, and I will talk to you in the next video.